I'm going to speak for about 35 minutes on the global scene as I see it, so Australia X. And I was waiting for my sort of Buddhist moment on top of the Great Wall of China last night. And when it occurred to me like this, that if you look at the pension scene, it's really worth imagining, and I would ask you to sort of hold this idea if you can, if you think it's worth holding. It's like a weather system. It has three parts to it. The first part of the weather system is an increased life expectancy. A smaller group of people are going to be part of the working population, and there's inevitably going to be a government reaction to that. The second part of the weather system is that there is increasing demand, and therefore there's a requirement to improve supply. And the third aspect is that post-GFC, there's a call from regulators for greater transparency, governance, and risk management. Now, all those parts of the weather system, some of that will apply to your market, not all of it. But I think when it comes down the weather system in Australia, there are aspects to it that are global and consistent. The two that I draw upon is every single pension system has to watch its government, and we'll talk about that, and I can give you examples post-2008 where governments do cancel pensions. And secondly, you need to stay ahead of the curve in what I call TKU, trustee knowledge and understanding. Clearly, the trustee model is a very good model, but regulators are increasingly interested in TKU being absolutely outstanding. And therefore, in the Australian markets case, where you have very good approach to that, it's always worthwhile believing that there's more you can do in that area. Okay, so I'm just going to go through some slides. So just bearing in mind what I said about the weather system, I'm trying to sort of each slide to sort of apply to that. So I really want to first of all touch on the changing landscape, what I call the global response, and then some key market views. So there may be a market I haven't mentioned here that you know very well. It was simply to just try and give a flavour. So these are some of the questions that are kind of being asked by people on the street. And of course, pensions is a proxy for the economy of a country. It's a proxy for lots of other things. I will inevitably try and draw some comparison between Australia and Europe. And you immediately have a bit of data which you may or may not find surprising, that the global economic group you're a member of, G20, many of the other members don't even have workplace pensions at all. It's simply you're going to be paid out of Pillar 1, and there's an assumption by populations in France and to a large extent in Germany and Italy that pensions will just be taken care. It's something that will be taken care of for them. So again, they're in the weather system. They may be unaware, but they are going to be tackling some of these issues, and certainly part one of the weather system. The working population is decreasing, they're getting older. What is the government going to do about it? Well, the government typically, as pensions has always really been a policy matter, and politicians generally enjoy issues, when those two start to come together, you get incredible dynamics, and it's already evident that governments can be thrown out for raising the retirement age, or in the case of France, they said we're actually going to reduce the retirement age. So all these things are interesting. They're become, over the last few years, as you know, highly politicized because of part one of the weather system, certainly where people are just going to be getting their pension from the current account of that country. So these are just some of the things that are occurring to folks, and the situation is dynamic. It's not entirely pessimistic. It's a mixed view. Certainly in Europe, there are countries that I would say really do truly look at pensions as a business very positively. If you take the Dutch, they arrived at what I call a collective bargain situation many years before Australia. It's all DB, of course, and now they've got to look at converting to DC. But they did get employers, employee representatives, governments, industry round the table and did agree to put together a system. And that's effectively what you did here in the 90s. These abilities to align these things, the kind of alignment of the moons, if you like, that's quite rare to pull that off. The way forward, obviously, when it comes to Europe is now that there will be no getting together, everyone around a table in the way you had in the Netherlands or in Australia. But there are attempts now, and there are positive attempts to bring more people into the savings catchment area, because there's a huge amount of people that just aren't saving at all. If I now focus on a moment for the UK, we've got what I hope is something of a little miracle. We've actually auto-enrolling something like 11 million people who haven't got any savings at all in their workplace. They will, of course, get the basic pension when they retire, but we're enrolling over the next 5 years 11 million people. That's a huge amount of people. Obviously, our working population is about 1.5 million employers into auto-enrollment. It's not compulsion. You get enrolled and you stay there. If you don't do anything, you start to build up a very small pot, but it gets you into a foundation, and you will have you will be making a contribution, and your employer will be making a contribution, which will leave you with something like, or you will have begin to build up a nest of up to 8% as early as, well, you will start to build it and have the opportunity to get to 8% as early as 2018. So there's some very good spots, and a lot of people thinking about how we get people starting to save. President Obama made a keynote speech in January this year. For the first time, he said we've got to get more people saving, and the assumption that everyone's in 401k, this sort of DC plan, that's not true. There are about 50% of the people in the workplace who have no pension at all, and he's created something called Myra, which is a very, very, very simplistic way by which you can have your own retirement account. You can put in something like $25 and start to build that up, and it will get invested in US Treasuries. But it's a way of building retirement. These are in the non-compulsory market. These are attempts to really start to get people saving. So I think, many of these problems have been identified, and you've watched, and they are ones that you're captured by as well, but some of which are very different. But the response to the response to the financial crisis is absolutely key, and it's really impacting pensions, certainly in the Americas, in North America, and in Europe. Because the regulatory response, or the G20 response, which has led to the regulatory response, that's really led to a fundamental re-examination of investment markets to ask whether those markets can be relied upon to operate in interest of the economy as a whole. So that is really building up a huge amount of examination of, ultimately leads to an examination of the way that pension funds are run, the way they're governed, and the way that if they look after money, the way they look at risk. I'll just give you a simple example. The UK government, in quite a short space of time, considering how pensions policy issues kind of don't connect, there's going to be a fee cap on UK DC of 75 bips coming in April next year. So really just quite hard stuff. When you think about the lobby, the lobby side of this, that's very, very significant. And that came out of a review, Office of Fair Trading review, so that DC fees are going to be capped. I'd never have thought that that would kind of be tabled as it has, and it's being done April next year before we have a general election in the UK. It's very, very interesting. So that's just an example of approach that is being taken to the way that investment markets are run, and are they being run for the good of the economy as a whole, and pensions are being caught up in that. Now, some of these ideas have been around pre-2008. Auto-enrollment was pre, so you really need to look back to the early noughties. But 2008 has really put, I think, energy and resources into the hands of the regulators. So that is impacting pensions, certainly Australia X. And that's a list of them. I mean, get your head around that. And I'm not going to answer questions to name all of them, because probably a couple of them are in French. But the fact is that is essentially dealing, you know your own one because it's at the top, but essentially they've all got typical headings. They're either trying to regulate something that was in a shadow market, or they're looking at an aspect of governance, transparency, or risk management, and they're all impacting and adding to higher costs for pensions, or indeed dealing with the lack of transparency on the manufacturing side of delivering asset management. So there are good things coming out of this. I believe that a lot of people believe that 75 basis points is a way you could run an asset management business looking after a bulk DC. We'll see. Some fund managers will say no, because I won't have the ability to innovate if I'm stuck at that level. But that's the world that everyone's going to be looking at. Some of these other areas, Dodd-Frank is very, very interesting. I know most of the assets in the room are DC. DB is very interesting, and Dodd-Frank impacts the way that a lot of assets, global assets, are looked after, because increasingly pension funds in the DB space want to manage their assets and their liabilities. When they come to look at their liabilities, they want to obviously deal largely with interest rates. Of course, they want to deal with longevity, but there's two monsters sort of eating up the value of pensions. When it comes to interest rates, obviously, you get a very nice piece of flex and capital efficiency if you can use derivatives. Well, if you're going to use derivatives, then you potentially have to go on exchange. And if you're going to go on exchange, you have to use collateral. So if you aren't exempt, and pension funds are made exempt, can be exempt in certain markets, you could be drawing on valuable amounts of your resources in order to manage these positions. But potentially the best way to manage interest rates is to use derivatives. So all sorts of challenges for pension funds all around the world. So we sort of, I didn't make up that participation, security, and adequacy strapline. It's around its OECD approach, but we're really aware of some of the different structures that are around. Touching on the multi-employer arrangements, there's a huge amount, which will be familiar ground to Australians, huge amount of interest now in the UK about multi-employer arrangements. Obviously, auto-enrollment, which is for people earning less than, let's just call it 40,000 Australian bucks, is effectively multi-employer arrangements, but great deal of interest how the DC market in the UK could now come together in some sort of super trust arrangement that would align it to how you guys run your stuff. Whether that's possible or not will be quite interesting, because there's some frightening statistics out there in terms of the amount of small pots people in the UK have. I think the TPR, which is the pensions regulator, is currently looking at 33,000 active DC pots. 33,000. And then there's a stat later that you'll see about by 2050, the dormant amount of DC pots is some frightening number. People are walking around in the UK with no idea, these pots. They've no idea that when they were working there, they were entitled to, or they may be in a DC plan, and they're just running around as active with this company, deferred in 5 other companies. No way to aggregate that. So this is sort of, but again, in terms of having a workplace pension, the UK is in quite a good position compared to some of the other markets in Europe. And of course, Ideally, you're in a DB plan. If you are in one, stay in it. Big discussion on scale and efficiency. I know you've done a lot of research. There's been some active research in Australia. Big row in the UK at the moment about scale and efficiency. The government wants to bang together 120 local government DB plans in the UK, which is about it's about sort of 400 Aussie. It's about 400 billion Aussie bucks. And they put out a consultation. Various people in the industry said it would be great if we had sort of 10 super funds. So rather than having 30 London boroughs, you just have one super borough that would run, because the profiles are exactly the same. And indeed, local government now actually, if you're a ratepayer in one authority, often the authority that you pay your rates to and the 3 neighbouring authorities all buy their services from a similar provider of whatever it is, doing the highways or cleaning the refuse. So why not pensions? So I came back. There's still ideas out there about common investment funds trying to consolidate. But the government has said, actually, we're very sensitive to the other political issues, the devolution issues that you've got. So we just suggest you all go passive. So they've now suggested that $400 billion is now run passively. So that's very interesting, because I know a lot of people here have a very clear view about active. So now suddenly there's a debate that's popped up about active versus passive, and it's going to be very interesting how the local government in the UK, how it decides to follow those guidelines from central government. The City of London is not going to like it. They estimate that's about, if they all go passive, that's about 400 million sterling of fees, of active money management fees. So there are big numbers being pushed around here, and like right now. Just in terms of consolidations across Europe, Finland had, I think, 6 pension plans. They're going down to 3. The AP Fondens are going to, they talked about merging, they're going to merge. The Dutch, I'm just really conscious of time, so I'm covering some things here, so you don't have to turn the pages, because we all had a very busy evening last night. But the Dutch, the DNB, which is the central bank and the regulator, went out to the 500 DB plans and said, there's too many of you. There's too much risk, we feel. They did bring out fit for purpose on trustee level. They just brought out generally, we don't have the capacity to supervise you. So they've asked for those pension funds to increasingly consolidate. So consolidation in the DB space is going on. And I think the UK government will have another crack at the amount of DB plans that are out there. Taiwan, similar position. Transparency, governance issues. It really, it just depends on what part of the world you're in and what you're talking about. I mean, we talked at the end of last week about, it was a big issue about transparency and what markets to invest in. The UK market, for instance, the US market, the Dutch market, they're really focused on transparency around what they own. They've become shareholder activism is absolutely massive. And I know Australia's been big signatories to PRI. It's sort of connected. There's data now that it's certainly data that says if you are actively involved, it doesn't lead to undermining your returns. It's probably neutral at best. So these are very big areas in the UK, and they're very big areas in Europe, and I think shareholder activism is certainly something that would be interesting to get a view about it, Gerard, from the group here. So that's sort of what a lot of the big pension markets are focused on. When they talk about transparency, they're not thinking about some of the things we touched on here. They're talking about literally going in and taking a view, buy and hold, and being pretty active with some of their investments. Compulsion versus soft compulsion. I mean, there's no such thing as soft compulsion. There's either compulsion or you're really pulled in some way. Certain types of government love soft compulsion. My own government, I'm a Brit, they like it because it's kind of quite fashionable economics. It's otherwise called nudge. If you've ever heard about it, it's all about just encouraging people to do things, and we're so apathetic we just hang in there and sort of just stay there. So I know there's some politicians in the room, so I don't know if you like nudge, but the current Prime Minister of Britain, he likes nudge. So it just seems the right of centre parties seem to like it. So they're using that, and to be fair, nudge is working on auto-enrolment. So I'm a guy who wants to go compulsion. I'm just told to shut up. So nudge is working when it comes to auto-enrolment, to be fair to the UK government. Contribution rates. I mean, this is something globally, and when you look at DC, often, and I am more familiar, where the employee and the employer both make contributions, and you are in a good tax position, I'm in a good tax position to go in to my plan. I'm a trustee and a member of the plan. Of course I am. I'm aligned to my plan, otherwise I wouldn't be a good trustee. But my employer, which happens to be JP Morgan, I know you've got the same deal as me in Australia, the JP Morgan people here, but I go in and put 6 in, they put 6 in, I put 6 in, they put another, whatever it is, and we get up to 18. I mean, it's matching is very successful, and I know it's not, you approach it from a different point of view, but the whole idea of getting contribution rates up, massive, massive push in the UK, just if nothing else, get people to optimize their contribution matching. So, I mean, this is obvious, but what is sort of more worrying is that outside Australia, the whole governance, the whole trustee knowledge and understanding is nowhere near what it is in Australia. Lots of recent data from the Brits around most DC trustees have no idea, have never taken. We've got a big piece of training online, trustee toolkit, massive, very difficult, bits of it quite hard to do. Annual training, conflicts of interest, sort of all the paperwork I do, because I work for a well-resourced pension plan. And we have 35,000 members, half deferred, of course, financial services, and half active. And so I've got lots of support, but we're about 2 billion. We're one of the biggest DC plans in the UK, okay? I mean, that's nothing compared to the size you've got in Australia. So we're one of the biggest. So imagine all the little ones dealing with kind of issues which have just come up, like the fact you don't have to buy an annuity when you reach retirement in the UK. So the issue around governance is absolutely massive for DC outside Australia. So trustee knowledge and understanding is a hugely significant area. And of course, all DC systems have the same issue around adequacy, member engagement. We've all got the same problem there around defaults and all of that. But if your starting point is you haven't got the governance right, real worry. And as I'll talk a bit later about the UK, we've just liberated 300,000 people a year from having to buy an annuity. So they're going to be sticking with their pops, their little pots. And what are we going to be helping them with? So we'll talk about that in a moment. Perhaps Australians can help us. We need some help. So really, challenges, trends and reforms. You're pretty familiar with this in terms of the transfer from the state or employer to the individual. And effectively, they're taking on the whole LDI themselves, they're not conscious of it necessarily. And in the UK, obviously, massive change in the contribution rates fell dramatically, which you can read up there. Participation, as I've said, amongst the G20 countries, back to that kind of image of the weather system, huge amount, there isn't a workplace arrangement for many of these countries. And there were noble attempts to look at setting up pension systems pre-2008, and we'll see how some countries dealt with that when it came to writing their books, trying to balance their books post-2008. We talked about adequacy, how contribution works. And member disengagement is really what should be described. This is very typical where the majority of people go. are into the default fund. Transparency, good stuff in a way. I think that the tackling of fees is very positive in sense it's opening up transparency. And I referenced the change in the approach that the UK government's taking, and it'll be interesting as they get a taste for actually what I call micro reform as opposed to macro reform, how when they review auto-enrollment and whether it's worked in the first review, I think is 2018, whether they then look at other things like, well, maybe nudge was a prelude to compulsion, and maybe they'll try and see if those 33,000 pots of money can be consolidated. Defined ambition, I don't know if anyone's heard much about that. It's really in the Dutch market and the Danish market to a certain extent, and these have been in the Dutch market a DB-driven arrangement. They don't tell you exactly what you're going to get when you retire. They are allowed to vary that with you. So the idea that you can, that's a really good definition of what defined ambition is. And that's been very successful. Of course, again, back to the fact everyone has agreed to these pension arrangements starting place. So the Dutch had a good starting place. They did have collective bargaining approach to pensions, and that's allowed them to protect themselves to a sense. So there are now, of course, employers in the Dutch market want to move to DC, and it'll be very interesting how the consensus has driven the Dutch market navigates through the change between DB and DC. The other idea around defined ambition, which the UK have taken up, was this idea, sort of, not necessarily you get a guarantee of what you're going to be paid in retirement, and of course, we're now in a new world in the UK because you don't have to get it, it's sort of where the money will be to the point of, previous point was decumulation, but now potentially you don't have to take an annuity out. But essentially it's this idea that even in the DC plan, that the employer, where the employer and employer are making contributions, that the you've put in will be guaranteed and given back to you as a capital sum. So at least it's guaranteed you get that bit back when you retire. So some enlightened employers in the UK are looking at these ideas whereby when you get to retirement, at least the bit that you put in, you'll get back. It's probably too expensive in the financial markets to actually, protect the return that you've been enjoying, but the idea that you get back is quite interesting. And some companies with low turnover, it does have dependencies, like people aren't moving jobs the whole time, but it's been quite interesting. Some supermarkets have done this. I think it's a way forward, what they call the hybrid between DB and DC, and it'll be interesting how that takes off outside Europe. How am I for time? Yeah. So we just rattle through this. I didn't come here really to talk about asset allocation. I thought, you've got a pretty good understanding of where things are going. You've got good friends there, and the Australians and the Australians you've got good friends in the UK and the US. The alternative, you've led the world. At the end, just touch on the Canadians, but you've really led the world in terms of, being significant investors in real estate and infrastructure. The comparison I'd make to somewhere like the UK is because there isn't consolidation, these funds often, haven't been able to find the kind of partnerships that I think scale has helped your market, certainly helped the Canadian market and other markets in Asia. If you look at icons like, if it is an icon, Battersea Power Station, I think it was in the Pink Floyd album, it's been bought by, it wasn't bought by, it must be a good deal. If you could turn it into shops, residential, whatever. It's not been bought by a UK pension fund. It's been bought by the Malaysian Provident Fund. They've got the money. So Asia and the creation of some of these, the way that you built your structures, the scale has allowed you to sort of really take on these significant opportunities in alternatives, including infrastructure and real estate. And the UK's had to respond to that. The biggest fund they've got in the UK is about 50 billion, but it really is a huge tail of funds. It gets quite small quite quickly. They've actually come together and created their own, in this case, it's a sort of a private equity platform, so they can actually go out, not have to go disintermediate the kind of investment managers and people like that, and go rather like yourselves and go directly to markets, or have the opportunity at least to make their own decisions. So interesting. I mean, speaks for itself for a pension fund. I think the only thing I would say here, just which could be slightly different to Australia, where your yields on your government bonds, I think, are kind of higher than they are in kind of Europe and the US, that the look at these type of assets, I think, for the pension funds which I deal with, is in some senses a response to equities. Memories are long for pension funds. The equity markets fell something like 40% in 2008, and then when they look at their government bonds, not yielding anything in real terms, and so effectively they're paying the governments for the privilege of lending money to them. And that idea that it's now really it's gone from sort of risk-free to return-free is kind of a sense you get, certainly from these markets. But situation which is helping the only free lunch in the investment business, which is diversification rather. So just really finishing up, these are a couple of markets I really, Gerard, I've sort of front-loaded most of my comments on these. The only thing I would really, sort of LDI is very interesting. We can touch on that if we wish in questions. The Dutch and the Danes, again, pretty progressive approach to the way they run things. And then I just got to dwell on this for a moment. It certainly did lead to further policy changes. You can read for yourself what the Polish government felt they had to do to shore up their short-term public finances. Ireland, Portugal, I used to talk to Portugal Telecom, well, I won't be talking to them anymore. France, and then the Royal Mail, very, very interesting how that one works. And we may want to talk about that a bit later, because that involved everyone getting around the table, and whether that's a good deal or not, I'm not sure, but the taxpayer will be bearing that in mind down the road. But these sort of significant changes and responses by governments goes back to my first point about the weather system that hangs over Australia. Is it hangs over everywhere. Governments can change their minds about pensions. They can change their mind about your pension system if they liked. And then Canada, we all seem to like Canada, not like going there in winter always, but good, adequate, sustainable pensions. I know you do partner with them and know this market quite well. When we were trying to look at consolidating our DB government market in the UK, which I talked about, which has completely failed, and it's not going to be consolidated right now, the idea was which would attract politicians, which is you could really create these big pools that could then invest in the UK infrastructure. It's funny, how, even in Australia, there are things that could be improved in your own infrastructure. And you've got these huge funds. How does that money get into the infrastructure? The UK's got that issue very significantly. We're the third biggest pensions market in the world, but we're not really investing in our own infrastructure. Serious issue, which is complicated and requires compromises. So I know from people in the room who have to deal with compromises, it's easy for me to say that. That's all from me. Thank you.
Thank you. Thank you, Benjie. It's a pretty big canvas that you've painted, and of course you'll be able to go through some of those slides at your leisure a little later on. Let's throw it over.